Welcome to this deep dive, brought to you by Talk Tickers. Today, we are taking a really exhaustive look at the Q3 2025 earnings call for Legend Biotech Corp, ticker LDGN, a major, and I'd say increasingly dominant player in the multiple myeloma cell therapy space.
That's right.
Look, our mission today, it isn't just to read off the numbers from a slide deck. We are here to cut through all the noise and deliver the critical insights you need about CARVYKTI's market penetration, their ramp to profitability, and I think most importantly, the strategic disconnect.
The big question.
The big question. Why did the market react by sending the stock tumbling, even though you had this really confident management team reporting strong operational wins?
Yeah, and this call, it was led by CEO Ying Huang and the new CFO Carlos Santos, held before the market opened on November 12th, and the narrative was just crystal clear. Execution, execution, execution.
Right.
Management was, really insistent they're moving out of that development phase and squarely into being a high-growth commercial operation. And it's all underpinned by this massive push on manufacturing capacity.
Okay, so let's unpack the immediate headlines then. On the surface, the numbers looked, well, overwhelmingly positive.
They did.
We saw strong top-line growth driven by their flagship asset, and that was combined with a meaningful improvement in operational efficiency.
But that's where the surface can be a little bit misleading. So total revenue came in at $272.3 million.
Which is a huge jump.
A massive 70% jump year over year, yes. But, and this is the key detail, it was a subtle miss against consensus expectations. They were averaging around, $273.5 million.
So why does the market care so much about $1 million shortfall on a number that's over $250 million?
Well, because for a high-growth biotech like this, investors are pricing in capacity scaling perfectly. That slight miss, it signaled to the market that either utilization rates at existing centers weren't accelerating quite as fast as projected, or the ramp-up of new capacity wasn't translating into build product just yet.
So just cast a little shadow of doubt.
A tiny shadow of doubt on future guidance, even if the miss was, technically marginal.
But if revenue was slightly soft, the profitability trend was definitely moving in the right direction, and that usually pacifies skeptical investors.
Precisely. They reported a GAAP EPS loss of -11 cents. That actually beat the street's consensus loss of -13 cents.
So good cost control.
Excellent cost control. And more critically, the operating loss narrowed by a very healthy 38%. It came in at -$43.5 million, which is way down from nearly $70 million just a year ago.
And where did that efficiency come from? Was it from cutting R&D, or was it better control over, say, sales and admin?
It was primarily driven by better leveraging of their OPEX as revenue grew and those initial manufacturing efficiencies kicking in. Management was very quick to point to this narrowing loss as proof that the path to company-wide profitability by 2026 is, viable.
Right, but there's the tension.
There's the tension. Management sees a clear path to profit, but the market is fixated on that tiny chink in the armor, the revenue miss, as a signal of potential execution speed bumps down the road.
Let's talk about the engine driving all of this. CARVYKTI. What were the commercial metrics that define its blockbuster status this quarter?
Okay, so CARVYKTI net trade sales hit about $524 million for the quarter.
Wow.
We are talking 84% year-over-year growth and a phenomenal 19% sequential growth quarter over quarter. They also made a point to emphasize that over 9,000 patients have now been treated globally.
Which really cements its place as one of the fastest CAR-T launches in history.
Without a doubt.
What's fascinating to me here is that even with this notoriously complex, high-cost manufacturing process autologous cell therapy, the gross margin stays surprisingly robust.
It does. They highlighted that the gross margin on net product sales is holding steady at 57%.
That's a crucial metric.
It is. It shows they're managing that complex supply chain well. And financially, they're in a strong position. They're holding about $1 billion in cash.
$1 billion in cash?
Yeah. And management confidently stated that provides them with a cash runway extending beyond 2026, which is the exact year they expect to hit that company-wide profit goal.
But all that cash runway, it's totally contingent on solving the industry's perennial bottleneck, which is capacity.
Right.
For years, the story around CAR-T has just been that demand outstrips supply, which frustrates everyone, from physicians to patients. Is that issue really being solved?
That was probably the strongest, most proactive messaging of the entire call. Management said they're executing a comprehensive multi-node manufacturing network build-out.
Okay.
This includes the big Raritan U.S. expansion, the new Tech Lane facility in Belgium, and of course, coordination with their existing partners.
And they gave clear numbers. which is so essential for investors trying to model future growth.
Absolutely. The critical target is 10,000 annualized doses by the end of 2025, with an eventual target of 20,000 doses.
And the big milestone this quarter was Tech Lane.
The major milestone was initiating commercial production at the Tech Lane facility in Belgium. And this is so strategic because it shifts production closer to that rapidly growing European patient population. It drastically simplifies the global logistics, the whole vein-to-vein time, which is just vital for patient outcomes.
A 57% gross margin is remarkable for such a rapid, complex scale-up. But is the market maybe skeptical that they can keep that margin as they push new facilities like Tech Lane into full commercial production at the same time? And that's a massive operational challenge.
It is, and that skepticism feeds right into the stock's weakness. However, management assured analysts that the efficiencies they're gaining from experience and bigger batch sizes are offsetting those initial startup costs.
So Tech Lane is the proof point.
The successful launch of Tech Lane is key to proving they can execute this global scale while holding those margins steady. They are basically shifting from having a capacity constraint problem to having a demand generation opportunity.
Okay, so if the capacity problem is turning into a demand opportunity, let's pivot to the strategic side, the regulatory landscape and how CARVYKTI is now positioned against its competition.
This is where CARVYKTI gains a massive strategic advantage. Management leaned heavily into its position as the leading multiple myeloma CAR-T, mostly because of a critical label update.
What was that?
It is now the only approved second-line therapy with an overall survival, or OS, benefit explicitly included in its U.S. label, and that's based on the CARTITUDE-4 study.
That is huge. That OS benefit directly informs physician choice and, reimbursement discussions. It gives them a clear leg up.
It fundamentally changes the prescribing dynamic. Physicians now have a clear, statistically significant reason long-term survival to choose CARVYKTI over older treatments or even competing CAR-Ts.
And it's backed by data.
It's further backed by the 5-year CARTITUDE-1 data, which showed that roughly 1/3 of heavily pretreated patients were progression-free at that extended mark. Management is pushing the narrative from treatment efficacy to, near curative potential in some groups.
Okay, however, the call did follow the FDA, adding a boxed warning for a serious gastrointestinal toxicity. And let's make sure we clarify that complex term, IEC-EC, for the listener. How did management address that pretty serious safety narrative?
Right. IEC-EC stands for Immune Effector Cell-Associated Hemophagocytic Lymphohistiocytosis and Macrophage Activation Syndrome. The reason it's so concerning is that unlike the more common and, generally manageable side effects like CRS or neurotox, IEC-EC is rarer but often much more severe and life-threatening.
So how do they frame it?
Management's response was very strategic. They framed their messaging entirely around the survival-driven benefit risk. They essentially told the market and the prescribing community that while they rigorously monitor and manage this risk, the unprecedented overall survival data makes the benefit ratio overwhelmingly positive.
So acknowledge the risk, but pivot right back to the benefit.
Exactly. Acknowledge it, but pivot immediately back to the longevity of life delivered.
So with capacity seemingly under control and a dominant regulatory label, the ball is firmly in the court of commercial execution. What's their market expansion strategy for generating all that demand?
Their plan has a few different facets. First, they're focused on expanding their U.S. authorized treatment center base, the ATCs.
Okay.
They plan to increase the number of sites from the current 132 toward a goal of 160 to 180. More sites mean more access points.
And what about the community setting?
That's the second part. They're working hard on increasing penetration in the community setting, which is vital for patients who can't easily get to those major academic centers. They noted that about half of their current patients are actually treated outpatient, which is a major advantage for access and cost efficiency.
Let's briefly touch on the pipeline.
Yeah.
Because while CARVYKTI is the driver, long-term valuation needs future assets. So beyond the push into earlier line multiple myeloma, what do they highlight?
Well, they mentioned progress in their frontline trials, CARTITUDE-5 and NIHILIS-6, and they confirmed enrollment is expected to be done this year. That's a huge step to shift CARVYKTI from later lines to the initial treatment phase.
And anything in other areas?
They also highlighted some early-stage programs in solid tumors and non-Hodgkin lymphoma, including the DLL3 targeted CAR-T, which is LB2102.
DLL3 is interesting.
DLL3 is noteworthy because it's a target you often find in solid tumors, like small cell lung cancer, a notoriously difficult area for CAR-T. So management sees this as building a necessary multi-asset pipeline, but, the market accurately views these early programs as highly speculative option value.
Right, given the history there.
Exactly. The difficulty in treating solid tumors with cell therapy is well known.
Okay, here's the critical pivot point in this analysis. The market sentiment disconnect. Management was confident, reiterating expectations for CARVYKTI profitability by year-end 2025 and then company-wide profitability in 2026.
And yet the stock acted like the company reported a complete catastrophe.
It's wild.
Despite the bullish tone and the EPS beat, the stock fell about 1.5% on earnings day, and the trend just continued. Later in November, the stock hit a new 52-week low near $26.33. That's a drop of roughly 18% from its pre-earnings level.
And this was happening while the rest of the biotech sector, measured by XBI, was actually rallying pretty robustly.
A staggering underperformance. The stock is lagging the XBI by, easily 30% over the last year? If execution is strong, capacity constraints are easing, and profitability is on the horizon, why is the market so skeptical?
That's the key question.
Well, investors are currently discounting several key factors. First, they're treating that capacity expansion story as guilty until proven innocent.
Okay.
Execution risk remains paramount until they actually hit that 10,000 dose target. Second, the safety overhang from the boxed warning is a psychological deterrent, even if management frames the benefit risk well. And third, the fundamental reality is a heavy reliance on a single blockbuster asset. The market needs to see that cash flows stabilize the valuation before it rewards the execution.
Which raises an important question. What do the professional analysts think, especially given the stock's massive drop?
The analyst consensus remains almost universally bullish. We're looking at 18 buy ratings, 1 hold, and 0 sells.
0 sells.
0. And crucially, the median 12-month price target is around $72 to $74. That suggests analysts believe the stock offers approximately 57% upside if the company just executes on its stated roadmap.
There is a gargantuan gap between the fundamental analysis and the current price action.
A huge gap.
Okay, now we move to our final segment. This is not financial advice. Everything we are about to discuss is for illustrative, informational, and entertainment purposes only. Please do not take investment action based on this segment.
Right. So given the scenario, a company that has demonstrated strong commercial execution, a clear, tangible path to 10,000 plus doses, and a defined profitability timeline, but coupled with a stock that has just been savagely punished, lagging the sector by over 30%, we are left with this massive valuation opportunity that the market just refuses to acknowledge.
So if you're a portfolio manager and you're looking to capitalize on that specific tension, how do you hedge the execution risk while still betting on the fundamentals?
It's a tricky one.
We pitch a relative value strategy. You initiate a long position in LGN, the fundamentally sound but grossly underperforming stock with clear catalysts, and you hedge it with a short position in the SPDR S&P Biotech ETF, the XBI.
The justification for this is pretty nuanced. This trade attempts to profit solely from mean reversion that's driven by company-specific catalysts.
So you're taking the macro out of it.
You're taking the macro out of it. You're betting that Legend's execution, specifically hitting the 10,000 dose target and the 2026 profitability guidance, will force the stock's performance to converge toward the analyst consensus and the sector's positive trend, regardless of broader volatility. It's a clean bet on capacity execution, closing that enormous sentiment gap.
A compelling idea, provided that the new CFO and CEO can truly eliminate that supply constraint narrative and maintain that impressive 57% gross margin as they scale up.
A big if. Let's quickly recap the core takeaways. Our deep dive into the Q3 call confirmed CARVYKTI's blockbuster sales trajectory, hitting $524 million. It validated management's path to profitability by 2026 and highlighted the strategic capacity build, particularly with TechLane coming online to meet that 10,000 dose annualized target by year-end 2025.
And the central tension here remains the focus. The story has firmly moved into the prove-it phase. Management must now continuously convince a highly skeptical market that their commercial execution and capacity expansion will definitively outweigh the current discount factors.
Which are single asset reliance and regulatory risks.
Exactly. The boxed warning.
So here is the final thought we leave you with. With capacity constraints seemingly transitioning into a non-issue, the focus shifts entirely to demand. Given the immense strategic advantage of the new overall survival label, how rapidly can the company translate that clinical benefit into increased utilization as they push toward 160 to 180 U.S. treatment sites?
That acceleration rate, that's what's going to define the stock's trajectory for the next year.
Thank you for joining us for this deep dive.
Remember, everything discussed today is for informational purposes only. We'll catch you next time.